knowing that what is taxable or what is deductible from the IRS position versus the financial accounting position shouldn't be a surprise that sometimes we end up with what's called a net operating loss. And what that is with from a tax perspective and for tax purposes, in a year in which those changes, so those tax deductible expenses, exceed what the taxable revenues were, you get what's called a net operating loss. Federal laws permit taxpayers to use losses from one year to offset profits of other years. So then what you get is a loss carryback or a loss carry forward of those net operating losses. So it's not completely lost. Under these rules, a company doesn't pay income taxes the year in which it occurs, the net operating loss, and then they can, in those periods, 2 years back and up to 20 years forward, offset their profits and lower their income taxes payable in those periods. So loss carrybacks go back 2 years, then they go forward up to 20 years. When we go back the 2 years, you have to go back to the earliest year first and then the next year. Now, if your loss that you have incurred does not get completely eaten up in those 2 years before, then you can continue to elect to either forego your carryback loss, or you can carry forward your loss 20 years. So let's look at Conlin Corporation and how this works. Conlin Corporation had this tax information. Here's their taxable income, their tax rates, and the taxes that they actually paid, so their income tax payable for 2015, 16, and 17. In 2018, they incurred a pretty significant net operating loss of $480,000, which they elected to carry back. The 2018 enacted tax rate is 29%. So we are going to record the effect of the loss carryback. Let's look at a columnar representation of this information. So here is the financial income for each year. Here is the income, the taxable income. You see in 2018 where we had the $480,000 loss, and here's the applicable rates. So if we're going to carry back $480,000 of taxable loss, let's look at the taxable income in each of those periods. We're going to apply $155,000 to 2017 and $325,000 to 2016. Now remember, we have to go back 2 years to the earliest year first. So that's $325,000 that is consumed for 2016. The residual we can apply to 2017. We apply the appropriate income tax rates. To determine what the revised income tax is for those years. So in 2016, we would have no income tax, meaning that the $97,500 that we had remitted is now going to be refunded to us. And the difference between the $120,000 remitted and the $73,500 that is our income tax revised as a result of a carryback, gives us $46,500 that will be refunded to us for an amount of $144,000. So now that we have calculated all of this, we have to look at what is the journal entry to account for those. So we have an income tax refund receivable of $144,000. And then we recognize that to an account called benefit due to loss carryback. That is what we would see on our income statement. Let's look at Road Incorporated, who had a net operating loss of $500,000 in 2017. Combined income for 2015 and 16 was $350,000. The tax rate for all their years is 40%. And Road elects the carryback option. Let's look at the entry to record the benefits of the loss carryback and the loss carryforward. So in 2017, we have the $500,000 in net operating loss. When we apply it to 2015 and 2016, we get carryback of $350,000, giving us a continued loss of $150,000. We no longer would have taxable income in those 2 prior years. At the current rate, that $150,000 that we've not yet used is a $60,000 potential benefit to us. So we'll be receiving back $140,000, and that is our benefits due to a loss carryback. Then we go to our deferred tax assets, and we'll post a $60,000 because we're expecting a savings of $60,000 in income taxes payable in a future period. And we would have a benefit due to a loss carryforward, so a separate account that we would recognize that $60,000 in. Now we're still using Road, but we're going to tweak this a little and say that we're going to assume it's more likely than not that the net operating loss will not be realized in future years. So what do we need to do for this to be handled? We have our carryback provision. We had our deferred tax asset. And then we have a reversal, in essence, where we will debit our benefit due to a loss carryforward. We will adjust our deferred tax assets. If you remember, we talked about when we expect that it won't be realized, we use that allowance account to the deferred tax asset. So let's just revisit that valuation allowance. Now, whether a company has realized their deferred tax asset really depends upon taxable income, and whether it is going to exist in a future period. Some taxable income sources, things such as future reversals of existing taxable temporary differences, are going to impact that future taxable income that is going to be exclusive of reversing the temporary differences or taking advantage of the carryforwards, taxable income in prior carryback periods, tax planning strategies. This, like I said, is a very, very specialized type of accounting. So evidence that would lead towards the negative. Histories of operating losses or tax credit carryforwards expiring because they're not used. Losses expected in early future years by a company who is currently profitable. Unsettable circumstances that, if unfavorably resolved, would adversely affect the future operations and profit levels of the organization on a continuing basis in the future. So potentially something litigation-wise. A carryback or carryforward period that is just so brief that it would limit the realization of the tax benefits. Significant deductible differences that are expected to reverse in single years. Or if the enterprise operates in a traditionally cyclical business. Positive evidence would be existing contractors or firms' sales that are going to produce enough taxable income to realize those assets based on current sales prices or cost structures. If there's an excess of appreciated asset value over the tax basis on the company's net assets in an amount that is sufficient to realize the deferred tax asset itself. A good earnings history. When we exclude this one loss factor that's going to create future deductible amounts, or deductible temporary differences that are coupled with evidence indicating that the loss is really an aberration and it's not something that has drastically impacted the business, and therefore it is going to continue to occur, that this is now the new norm. Now that we have talked pretty in depth about accounting for income taxes from really a financial accounting perspective, this is not an end-all be-all of income taxes itself, because remember, that tax code changes. So these temporary differences and or permanent differences or tax rate changes are things that are going to occur on a regular basis. You're going to have to visit these if you are practicing financial accounting potentially.